The FTSE 100 surged 236 points on Wednesday. Oil collapsed 14% in a single session. The pound hit its highest level since March 23rd. By almost every measure, April 8th was a relief rally, the kind of day markets call a turning point. And yet, Halifax quietly released a number that told a different story. The average UK house price fell 0.5% in March, dropping to £299,677, the first monthly decline of 2026. Annual growth slowed to 0.8%, down from 1.2% the month before. The ceasefire arrived. The housing market did not notice. That gap is the story. While traders celebrated the end of the Iran war's acute phase, the UK property market registered damage that had already been done. Weeks of elevated mortgage rates, suppressed demand, and a buyer population that quietly stepped back from the market in March. Pull back to late February. The Iran conflict had just begun. Oil was rising past 100. Inflation expectations moved with it. Lenders repriced mortgage deals within days. Halifax's data shows the damage ran through March in full. Hundreds of the cheapest mortgage deals were pulled. Buyers who had been ready to move paused. Sellers who needed to sell accepted lower offers. Average UK house price falls amid market uncertainty and Iran crisis, as The Independent reported, with Northern Ireland the only region still showing strong annual growth. The 0.5% monthly decline reverses a 0.3% rise in February, before the conflict. That swing of 0.8 percentage points in a single month is the sharpest directional reversal in UK house prices since the post-mini-budget shock of late 2022. Now zoom out further. The annual growth rate of 0.8% is below wage growth for the first time in 18 months. That means real house prices are falling, not just nominally. A market that was supposed to be recovering in 2026 has instead stalled at a level that should have been a launchpad. The mechanism is straightforward. What Iran's ceasefire means for fuel prices, inflation, and interest rates in the UK, as Yahoo Finance reported, is that oil falling to £93.93 a barrel offers relief, but jet fuel and petrol prices are expected to remain elevated for months. The fuel price cap will not reset until the next quarterly review. Mortgage lenders will not reprice overnight. Capital Economics warned the same day. There's still a lot of uncertainty. The path of mortgage rates depends on how quickly energy prices feed through to the broader inflation picture, and the BOE is not going to cut on the basis of one day's oil move.
That sentence contains the entire housing market outlook. The ceasefire is 2 weeks long. The housing market moves on 6-month cycles. That mismatch is the weight of evidence pointing toward a delayed recovery. Even if the ceasefire holds and Brent crude stabilizes near $94, UK 10-year gilt yields closed April 8th at 4.85%, up from where they started the week. Lenders price mortgage rates off gilt yields, not oil. The bond market's message on April 8th was not relief, it was caution. The strongest counterargument is speed. If the Strait of Hormuz remains open through the 2-week window and a permanent deal follows, energy inflation falls faster than the BOE's current projections assume. That opens space for a rate cut, possibly as early as June. European bonds surged as traders trim bets on interest rate rises, according to the Financial Times, and UK borrowing costs did fall intraday, but closed higher. The bond market gave back its own rally by end of session. The weight of evidence leans toward this. The housing market will recover, but not in spring. The damage done between late February and early April, pulled mortgage products, canceled viewings, repriced expectations, takes 2 to 3 months to unwind. Summer is the more credible recovery window, and only if the ceasefire holds. The benchmark to watch is the 2-year swap rate, which lenders use to price fixed-rate mortgages. If it falls below 4.0% in the next 4 weeks, lenders will begin rolling back rate increases. If it stays above 4.2%, the spring selling season is effectively lost. On April 8th, it was sitting at 4.18%, exactly on the fault line. If the ceasefire fractures before the 2-week window closes, oil reprices back above $110, gilts sell off, and house prices in April follow March's decline. That is the scenario in which £299,677 is not a floor but a ceiling for the foreseeable future.